Let's start off with the US. I mean, we've got the White House deadline set for this Friday, July the 22nd, and this for a deficit reduction deal to raise a ceiling on what stands at $14.3 trillion. Some saying common sense will have to prevail at some point. Your assessment of where we stand right now?
One sincerely hopes that common sense does prevail, because the ramifications of a debt default, I really think that many people actually haven't really thought through the full knock-on effect. And really what I mean there is, if you look at the US agencies for the last 100 years, the fundamental plank of their business policy has been the US government is the AAA. It's undoubted, and everyone else is benchmarked off them. So if you have a situation where there's a default, and I know Standard & Poor's, for example, have already said they will take it down to double-D in the event of a default, assuming that they then apply consistent methodologies to what they've applied to everyone else in the world, they will then have to downgrade significantly all the corporate debts, because the sovereign has come down. That in turn will trigger various covenants in the loan agreements. This debt will not be allowed to be put into various portfolios. And it really could make the last crisis look tame.
And it's a ripple effect that extends globally, with implications grave for debt markets on a global scale.
Absolutely, absolutely.
So let's go into that and some of those implications and how we can start to see those ripple effects starting to be felt specifically in emerging markets.
Well, if one looks at it, the emerging markets typically are being seen, or have for a long time been seen, as more risky. You talk about your risk on, risk off trade. So whenever I find it quite interesting, whenever there's a problem in the developed markets, the swing seems to go over the top to the emerging markets. And if one looks at the world over the last 10 years, just 10 years ago, the basic principle of the international agencies, and I'm very simplistically speaking now, but it was that the developed world was basically no risk, AAA, AA, the emerging world, a lot of risks in it, and most emerging market countries were speculative grade. Now, if you look at the way the world has changed over the last 10 years, that is no longer applies. And if I look at the likes of Greece and Portugal, I mean, 10 years ago they were rated Portugal AA+, Greece A+. They're now down ridiculously over the last 18 months. And the risks are actually more, ironically, in the so-called developed markets than what we're finding in most of our big emerging markets.
Are perceptions of that risk changing in tandem? Because we saw this potential for US downgrade on its credit rating coming as quite a shock when it emerged last week.
Well, I don't know how it could be a shock, because if one looks at there's two issues here. One, what I call the politics. And if the politicians don't get their act together, it will default. But you go beyond that and say, even if they do get their act together, at what stage does the US, how much debt does it actually have to take on board before one actually questions from a fundamental basis whether the US is indeed still the AAA? So even if they do a deal now, unless they do a deal to bring down to sustainable levels that debt pile that they've got, all they're doing is they're delaying the problem.
Absolutely. All you're doing is having this debt overhang increase, and the question's got to be asked, when does it become too much? When does that printing press actually overheat?
Yes,
okay, absolutely. Well, we've heard commentary that further monetary easing could well be on the cards as we move forward here, potentially flooding global markets with dollars. Where we do see the potential for the stimulus now coming to the fore, let's ask the next question, impact of more dollars floating around here, because it would have an impact on commodities, in turn inflation, and that having dire consequences specifically for emerging markets.
That's correct. Yeah, as I say, the knock-on effect hits the emerging markets more, particularly in terms of the food inflation. But to tell the truth, I'm quite surprised why this dollar hasn't depreciated more. Once again, how much do you actually have to put into the global markets?
Almost a tug of war, though, and what's happening in Europe and what's happening in the US. Who's painting the better or worse picture at any given time? It
is. Wouldn't it be nice if there was an alternative global currency, the renminbi or whatever the case may be? But right now, it's just who's the worst. And yeah. It's a little bit down the line, but maybe we should be looking at an alternative currency.
What's the likelihood of a similar scenario emerging in emerging markets?
Well, the knock-on effect, as I say, definitely will hit emerging markets, and it'll probably be exacerbated. But the practical realities, there's a good and a bad to this, because I believe over time the risks will be perceived and rated more accurately than they are right now. As I say, you cannot have a situation where Greece or Portugal is AA. I mean, how can Portugal be one notch lower than Germany was
So this is exactly why ratings agencies like yourselves have come under extreme fire. So run us through your experience over the the recent past, because one can assume heavy criticism being dished out.
Well, as an industry, we have taken an absolute hiding over the last 4 years. And if you looked as an industry, there was a very good track record for ratings versus probability of default up until very recently. But in my opinion, sort of two things happened. One, the rating agencies, we started to fail on what I call the logic tests. So a very good example of that is if one looks at the subprime crisis, the basic flawed logic was the assumption that housing prices in the United States are going to keep on going up. Now, I don't care how many rocket scientists you've got, just apply common sense. It's got to be wrong. Then you've got to apply consistency. So in the emerging markets, what was being applied was we would look back 50 years and apply the worst case loss severity, the worst case default, and then assume both of these would happen into the future and put sufficient cover in there. So what one needs to do is we actually need, I think, to reform the international credit rating system to more accurately reflect the risks as they stand now. It's just not the level of divergence in risk between the so-called emerging markets and the developed markets that is currently being reflected in the ratings.
Do you see the emergence of more credit ratings with an emerging market voice coming to the fore? Because as it stands right now, it's the US voice that controls or dominates this playing field.
Well, I believe that will happen in the next 18 months. And just to give you some background, if I look at let's look at the BRICS markets. The Indian rating agency is the biggest rating agency in India. Its market cap is about 1.3 billion now. 3 years ago, Moody's was 50 times their market cap. Now it's about 7 times their market cap. If one looks in China, in Africa, the independent ratings are far away the biggest rating agencies in those markets. To me, it's just a question of pulling together some of these organizations to be able to compete head on. So I can tell you now there's a lot of work happening right now, and there's a lot of support for the concept.